All right, let's jump right into this explainer. Today we're tackling basic accounting terms, but we're looking at them in a completely different way. We're not going to treat accounting like it's just dry math or, staring at boring spreadsheets. Instead, let's frame it as the living, breathing language of building a successful business. Think of this as the ultimate builder's journey. Every single term we pick up today is going to be a vital tool in your tool belt. So let's get building.
To kick things off, we really have to ask ourselves a fundamental question. What actually changes a company's financial position? Because a business doesn't just sit there, right? It breathes, it moves, it acts, and every single heartbeat of that business is what we call an economic event. Now, in the language of accounting, when that economic event is expressed in terms of money, well, we call that a business transaction.
Which brings us to Section 1, the language of business. Because honestly, every journey starts with a transaction.
Whether you're buying supplies, paying the rent, or selling your absolute best product, every single action in our builder's journey gets recorded. And what's really fascinating here is that every transaction has dual aspects. There's always a receiving side and a giving side. It's like a seesaw. Before we even break these down into, everyday business actions, we categorize them into broader types. Understanding these high-level categories is absolutely crucial. It's basically the foundation of how we keep our books.
So to see just how versatile this language really is, we classify transactions based on two main things. First up is the mode of settlement. A cash transaction means the receipt or payment happens right then and there. Boom, done. A credit transaction, on the other hand, means cash isn't involved immediately, but it'll be handled a bit later down the line. We also look at the relationship. Internal transactions happen entirely within the accounting unit itself, while external transactions happen with outsiders. It's just a beautifully structured way to track every single move a business makes.
Moving right along to Section 2, owning versus owing. This is where we really start building the foundation. Okay, I want you to put yourself in the builder's shoes for a second here. When you start a company, the very first thing you got to figure out is what you actually have versus what you owe other people. So the absolute bedrock formula is this. Capital, which you might also hear called owner's equity or net worth, is simply the amount that the proprietor or the partners invested into the business. How do you calculate it? You just take whatever is left over after you subtract your liabilities from your assets. Pretty straightforward, right?
But let's talk about the flip side for a moment, our financial obligations, or liabilities. Basically, this is the debt the business owes to outsiders. And we break these down by time. Non-current or long-term liabilities are loans that are payable after more than a year. Current or short-term liabilities, those are the obligations you absolutely have to pay off within 12 months from the end of the accounting period. So it's all about the timeline.
Now, what happens when the business owner wants to take a little something out for themselves? Say the boss pulls cash or maybe some goods out of the business for personal use. Well, in accounting, we call that drawings. And it's a super important concept because making drawings directly reduces the owner's capital investment in the business. You take from the pot gets smaller.
All right, let's jump to the other side of our foundation, assets. These are the properties owned by the business that we actually use to carry out operations and, generate revenue. And just like liabilities, we classify them. We've got non-current, current, and fictitious assets. Let's zoom in on those non-current fixed assets for a second. These are held long-term to boost our earning capacity, right? They aren't just sitting there waiting to be resold. Now, we can contrast tangible assets. Think land, buildings, furniture, things with a physical existence that you can actually see and touch, with intangible assets. Intangible assets, like patents or a company's goodwill, have literally no physical existence. You can't touch them, but make no mistake, they still hold immense value for the business.
And then we have this kind of strange term, fictitious assets. I know, it sounds completely made up, but they aren't tangible and they aren't intangible either. They're actually just deferred losses that haven't been written off in the year they were incurred. Instead, they get spread out over more than one accounting period. It's an accounting trick of the trade, basically. All right, let's shift gears to Section 3, day-to-day operations. This is the real engine of the enterprise. So we've built our foundation, and now it's time to look at the daily, constant flow of buying, selling, and managing cash that keeps the whole business alive and kicking. First up, bringing money in. We've got to clearly distinguish between our receipts. Revenue receipts come from the normal course of business, like the cash you make from actually selling your products.
Capital receipts, on the other hand, are amounts you get from non-revenue transactions. Think of it like taking in a one-off lump sum from selling off an investment or even a piece of the business itself.
And you know what? The exact same logic applies to the money going out. Revenue expenditure covers your daily operational costs, the ones that expire during the accounting year. We're talking rent, electricity bills, the cost of goods sold. Contrast that with capital expenditure. That's the big money. That's what you spend on acquiring or improving long-term assets to beef up the business's future earning capacity.
Let's do a rapid-fire map of exactly who owes whom in the ordinary course of business. On the receiving side, we have trade receivables. These are our debtors who owe us money, and our bills receivable. Then, over on the giving side, we have trade payables, our creditors who we owe, and bills payable. It's a constant, delicate balancing act of tracking our daily trade relationships.
But, well, here's the harsh reality of business that we just have to talk about. Sometimes the folks who owe you money, those debtors, they simply don't pay. It happens. When that amount receivable becomes absolutely irrecoverable, it gets recorded as a bad debt. And unfortunately, the business just has to treat that as a direct loss.
Now, to encourage trade and, get people to pay quickly, businesses use discounts. But there is an absolutely crucial difference here. A trade discount is just a reduction on the initial price tag of the goods. A cash discount, though, is an expense-saving discount specifically given as an incentive for paying a bill promptly. So, it's two different tools for two totally different operational goals.
Which finally brings us to Section 4, the bottom line. Time to measure the heartbeat. This is the moment of truth. It's where the builder tallies up the results at the end of the accounting period to see, okay, did the business merely survive or did it truly thrive? We measure our success through profit, but there are two levels to look at. Gross profit is your revenue from sales minus just the direct costs. But the true ultimate metric, that's net profit. That is the profit left over only after every single operating expense has been totally deducted. And hey, if your total expenses end up being more than your total revenue, well, then you've got a net loss.
Let's tie all these core financial outcomes together. Income is your steady profit earned during an accounting period from your day-to-day operations. A gain, on the other hand, is an irregular, non-recurring increase in equity, like if you sold a piece of machinery for more than it was originally worth. And a loss? Well, that's that detrimental excess of expenses over revenues, which unfortunately decreases the owner's equity.
To capture all of this, the whole shebang, we create a balance sheet. I really want you to emphasize this in your minds. The balance sheet is the ultimate definitive snapshot of our business builder's journey. It lays out the assets, the liabilities, and capital on one specific date. It mathematically proves that the receiving and giving sides of every single transaction we made throughout the year state perfectly exactly equal.
We're bringing it all home now with the ultimate why this matters moment. Correctly managing your assets, your liabilities, your receipts, and your expenses, it's literally the difference between these two states. Being solvent, which means you're in a healthy, strong position to pay off your debts, and becoming insolvent, where you're completely unable to pay what you owe. Nobody wants that.
So I want to wrap up our explainer today by leaving you with a highly provocative question. We know now that every single transaction has a dual aspect, right? A receiving side and a giving side. Everything has to balance. So what happens to a business when the balance sheet inevitably stops being equal? Think about that one as you continue to explore these terms. Keep referring back to these concepts. And hey, happy building!